reporting, okay, we got the official confirmation from the Federal Reserve. David Kudla, kick us off here. What was your impression of what you heard yesterday, and where does this go now in terms of investing?
Well, we certainly saw Jay Powell reinforce the hawkish tone that we've been hearing out of Fed presidents and the forecast for a very hawkish path for monetary policy in 2022. I think two statements that were important is that they expect that they could increase rates at every meeting this year if needed. Every FOMC meeting is a live meeting, and even more so that he stated that the labor market was strong enough that it could withstand rate hikes. And with that, markets took that very badly, really a reinforcement of hawkish tone. But I think the important thing to remember here is he hasn't done anything yet. The Fed hasn't done anything yet. In fact, they didn't even stop their quantitative easing. They're still buying assets, and they have a very hawkish tone, but that's all talk. The action right now is they're still buying assets. And I think we need to see what happens to inflation throughout the year and what happens to the economy before we talk about 5 or 6 or 7 rate hikes, some of this bidding war we had a week ago on how many rate hikes there would be in 2022.
Yeah, I think you're spot on that. It really struck me the other day when I realized they were still in the bond programs, buying up securities every month. They're going to just turn this around immediately in March, start raising rates, and start taking that balance sheet down from the close to $9 trillion. David, knowing that we are now expecting 4 rate hikes at least, Dan Niles just said 5, 6, Jamie Dimon said 6. Does it make sense to you that we're going to see bigger moves every month, every meeting rather? In other words, maybe it's not 25 basis points, but it's a half a point cut, a raise. Do you think we'll start seeing 50 basis point raises beginning in March?
It's a possibility, and it's all about inflation. You know, we get the February inflation read about 6 days before the March FOMC meeting. So there's probably another opportunity there for the Fed to pivot even more hawkish or maybe a little bit more dovish. But it is realistic that if, you know, what Jerome Powell has said is they are going to fight inflation, and they're going to fight inflation at the expense of what might happen to the stock market and other factors. They're going to fight inflation. So if that means 50 basis point rate hikes along the way, they would do it. But I think I would caution that with, you know, we may see a rate hike in March. We may see another rate hike. But I think as the year unfolds, we see where inflation really heads when some of the durable goods inflation component that's been was inflationary in 2021 actually contributes in a deflationary manner later this year. We talk about year-over-year comps on earnings. The year-over-year comps on inflation are going to get tougher this year in terms of seeing higher and higher numbers or sustained high numbers. So I think that there's a very hawkish tone right now that has created a lot of volatility in the market, a lot of angst in the bond market with rates rising. Let's see where we're really at in a couple months.
Yeah, I want to get your take on the earnings story because Intel and Tesla reported last night, and they beat expectations on revenue. But I, of course, have been worried about this chip shortage, and sources tell me that it actually worsened at the end of last year. Later after the bell, we're getting Apple and McDonald's and Comcast, David. But before I get to earnings, I got to bring Dagan McDowell in here because, Dagan, you've been talking about this monster balance sheet now for weeks going into this move from the Fed. Your reaction to what you saw yesterday, Dagan?
Jay Powell said bupkis, nada niente, about the timing of reducing the balance sheet, when or at what pace. It's at almost $9 trillion. It was at about $800 billion before the financial crisis. I'll just point out really quickly that the Fed continued to reinvest the proceeds from the balance sheet for more than 2.5 years, taking maturing securities and reinvesting them 2.5 years before they actually started drawing down the balance sheet. That's after the financial crisis in 2008. To pick up on a word that David said, tone. I just think that the Federal Reserve right now is all about jawboning, trying to scare speculators and the speculation out of the economy and some of these assets. But you've heard time and again from people coming on your show is that I think it's a buying opportunity when they talk about buy crypto, buy Bitcoin on the dips. So I'm not sure that the Federal Reserve, just through talk and chat and threat, will be able to really take the froth out of these markets. And so it will fall on them to hike interest rates faster than people are expecting and to start drawing down that balance sheet and not wait 2.5 years to start doing it.
Yeah. All right. We will watch. Larry Lindsay said a similar comment about the Fed not giving clarity on that end of it at all as well, David and Dagan. David, great to talk with you. We so appreciate it. Real quick before you go, are you buying here? Are you allocating capital differently based on what you heard?
We're allocating capital differently, and it was even before this Fed meeting. I know there's a lot of people that are talking about, should I be out of stocks? We think it's just a rotation. These non-profitable tech stocks, and stocks across the board, like a Robinhood, the high flyers with no earnings, that are highly indebted, highly leveraged, versus the bellwethers, the blue chips like Apple and Microsoft that have quality fundamentals. Those are the stocks you want to be in each sector, and you want to be avoiding those highly leveraged and non-profitable companies, a lot of them in tech, that just won't have all that free money sloshing around that they've had the past 2 years. To bid them higher.
I mean, it's certainly the liquidity situation has done wonders for the banks, that's for sure, with so many people putting money into their deposit accounts. David, it's great to see you. Thanks so much for your reaction and insights on all of this. We'll catch up soon. Thank you, David Kudla, joining us this morning. Stay